Hey guys, Stephanie here, and I want to take the time to make a quick video about something that's been all over the news this week and honestly popping up in my everyday conversations. And that's what's going on with Silicon Valley Bank and to a greater extent, macroeconomics. So let's back up. Silicon Valley Bank is a bank. They specialize primarily with tech moguls. So 8 days ago, the news started coming out when Silicon Valley Bank went to sell a large amount of treasury bonds. Remember, the way banks work is when you as a client, a depositor, go and put your money into an account, they have the right to then go lend it out to other people and make interest or put it into securities. Or most banks have what we call an 80 to 90 deposit ratio, which that money's not sitting there in the bank. So 8 days ago, Silicon Valley Bank said, our depositors are asking for more money. We don't have it on hand. We need to liquidate and get some cash right now. So they sold off their treasury bonds, taking a loss of $1.8 billion. This made people nervous. So then they went and started withdrawing their funds from people who bank there. Well, if you take a loss of $1.8 billion and you had, say, invested 80 to 90% of your capital, you're not going to have enough money as a bank to stay liquid. The government on Monday then announced that they were going to use from the FDIC to repay all of those depositors. Everybody's money was going to be insured, which is great, right? The government wants to make sure that we're feeling confident in our system. Silicon Valley Bank had invested, they had that loan to deposit ratio specifically in treasury bonds. Well, over the past year, the Fed has been increasing the interest rate, right? I work in real estate. It's been a huge, big deal. We've all heard about it. Well, that interest rate also applies to things like treasury bonds. And if most of your money is invested in that and the interest rate goes up and the yields go down, the amount of money you're going to be pulling from those bonds is going to be less, which is how we got in this situation. And that's macroeconomics. There was inflation happening in the country. The Fed increased interest rates, which is just really their only tool in this situation. And the goal was to bring inflation down, but then there are side effects like treasury bonds not yielding as much. This macroeconomics, while it sounds big and huge, the thing we all have to remember is that it impacts our microeconomics on a day-to-day level. If we roll back to 2008, I wasn't in real estate. I was your friendly bartender. And I noticed it then because all of a sudden people who came into the bar switched from drinking Crown to well liquor. They didn't want Crown anymore. They wanted the bottom of the barrel. They changed their spending habits. Now with what's going on at Silicon Valley Bank, the Fed now is saying maybe they won't have another interest rate. They're meeting next week to talk about it. Maybe they won't increase interest rates again. Maybe they still will. We don't know what they're going to do, but it's making people feel uneasy. All of these things add up. While I'm not the neighborhood bartender anymore, I still do care about the neighborhood I live in. So much so that a few weeks ago, I went to a city planning meeting for Royal Oak. And one of the number one concerns I heard was about affordability, was about available housing. Well, that's great, but it's not going to change the prices of our homes going up because we only have so many homes on the market. That's what we call supply. We still have a lot of buyers looking to buy them. That's what we call demand. Supply and demand are what dictate the price right now. Other factors like interest rates, like people feeling good about the economy, those also tie into their decisions, and the city can't make a change about that. Understanding these components and understanding how they affect things like our housing, like how we spend our money, like interest, inflation, it ties it all up and together. About this further, I would love to go on and on about it. Drop me a message, leave me a comment, or just scroll past and keep going.